This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Pippa's picture that says looking for the downloads. All right, Eric, let's start by covering crude oil.
Because we're releasing this show on Wednesday instead of Thursday this week, I don't have access to the EIA inventory data. API, however, reported a massive 6 million barrel drawdown. That would be the biggest drawdown since Thanksgiving of last year. So if that is confirmed by the official EIA report on Wednesday, it could very well lead to a continuation of the rally that we've seen over the last couple of days. Renewed upside momentum on Monday took us back over the short-term moving averages. Really looks, if you take a look at the chart, like, oh boy, it's game on. Maybe the bottom is in for crude oil. We're finally taking off again. I think the reason for that, though, is banking crisis fears are easing. And my question is, how long is that going to last? I'm not convinced that the banking system is as stable as everybody wants to believe that it is. So if the banking situation resurfaces, I think it could take crude oil back down with it. And how many times has this market given us bull traps? So we're just about at the right level for the market to roll over again if it's going to. I don't necessarily think that it will if we really have seen the worst of the banking crisis, and particularly if some of the supply concerns start to hit the tape. Maybe the bottom is in, but I'm not going to bet on it quite yet. We also have OPEC meeting next week, but so far there have been no hints of any quota changes, so I don't expect any big changes there.
Yeah, Eric, on page 2, I have that crude oil May 2023 futures contract. And what I have here is the volume by price showing where the majority of the overhead resistance lies based on where the volume traded, as well as the 50-day moving average. And so what we had was earlier in March, a big breakdown in crude that saw us hit down that $65 level. And since then, we've been bouncing. But in technical analysis, what were previous supports and lows become overhead resistance when approached again. And while certainly it's been a strong $9-10 push off of the lows in a span of a week or two, but the real tell for whether this is meaningfully turned is what the price action does right here, right now. If the bulls are serious about making a meaningful turn on this, we should see a solid punch back into the high 70s and a consolidation up there to really signify that the breakdown that we saw here in March was just simply a liquidity-driven short-term event that is now having oil restabilize in an area that will give an opportunity for a much more bullish reaction. But if for whatever reason crude oil failed here in this kind of under $75 range, then the trend of lower highs and lower lows would still be uninterrupted, and I wouldn't take off the table that a double bottom retest of 65, or even in the more dire scenarios, if we see some heavy selling, we could go right down to 60. Now, I'm not forecasting that yet, but this is such an important level for crude, and watching what it does here in the next few days is going to be really important. Nonetheless, let's move on. On page 3, I have the S&P 500. And, well, Nick, I want to bring you on here. It's a really interesting price action in the S&P. Let's start off just talking about the levels.
Yeah, so looking at the past week or so, we've seen kind of a range-bound trade between 39.50 or so and 4,000, and we keep butting our head against that 4,000 level, which is a very key area. So right now, spot is around 39.80 to 39.90 or so, based on when we opened up today on Wednesday. And I'm looking at the OPEX for Friday, which is the March 31st OPEX. The implied move based on the straddle for that OPEX is 60 points in either direction. So the upper expected move would be around 40.40, and the lower expected move would be around 39.20 or so. Now, keep in mind, we have the quarterly caller by JP Morgan with the call wall at 4065 and a put wall at 3800. So my thinking is that if we see a push above 4,000 today or tomorrow with gusto, keep in mind we have GDP numbers tomorrow morning. We could easily push to 4065 area by Friday, and then past that next week, it's possible we push a bit higher because in the short term, it seems that the Fed has kind of alleviated the fears of any more bank collapses. So looking at again this week, key support 4,000. If we break above that, then I'm bullish to 4065 or so. If we fail that area, I think we could push back down to around 3,900 or so. And that would be my area of support to look at going forward.
Nick, I have to completely agree with that trade range. The 3950 is also where on page 4 we can see is the 200-day moving average as well. Of the highs of March were all coming along where that call wall is. So this trade range has been in place for a while, and it may very well continue in the days to come, contain the price action. What will be really interesting is whether or not the bulls prevail. I mean, the bears had a shot at this when we had those regional bank failures, huge fear surges in investor sentiment, and suddenly there was the conditions for a market breakdown, yet the market didn't break down. And so if we see all these fears alleviated, it does allow a reflexive rally to occur in the market. It'll be really interesting to see whether we can break those highs, because if we're north of 4,100 come next week, then the window really opens up for 42 or even 4,300 on the upside. Overall, I think that while the markets do have a lot of stress points that they have to deal with in the latter part of the year, but maybe there's a real chance we go higher before those risks really prevail. Nonetheless, I want to talk of Nasdaq, which has actually continued to be very, very strong on a relative basis. What are the levels on the Qs?
Yeah, so looking at the Qs, I noticed this week that tech's been a bit weaker than the broad market. Yesterday and the day before, tech was not doing too well versus the overall market, that being the S&P, obviously. But the key levels that I'm looking at right now are, spot right now is 308 or so. Upper expected move by the Friday OPEX, March 31st, is 314, and lower expected move is 302. Again, that's based on the straddle price for Friday's OPEX. Key resistance area is 312, and key support is 300, with a large call wall at 320 and a large put wall at 285. So again, if the S&P pushes higher, chances are the Nasdaq follows suit as well. But typically, tech leads the market a bit, right? So if we see tech roll over, and we're watching Google, Amazon, Apple, Meta, they're all sitting at key areas of resistance right now. If they break above those areas, then you might see a further rally in bond markets, because obviously the sheer size of these companies, they bring the market much, much higher or much, much lower based on how they move.
Nick, I have that NASDAQ 100 futures chart on page 6. And while you're right, in the last few days, it has certainly consolidated. But this chart just looks so bullish. And it's so counterintuitive, because those FANGs and a lot of the tech names were where so much of the 2022 bear market happened. But overall, in spite of a very strong surge higher, the bulls have actually contained all the price action very close to multi-month highs. And if for whatever reason the conditions continued to be favorable for the short-term upside, a break here anywhere above 13,000 could have us doing another short-term technical advance on the upside, probably even toward last summer's highs in August, where it was just north of 13,600. Nonetheless, will that overhead resistance be beat is definitely the thing to watch this week. On page 7, though, we have the VIX, and the volatility index back in March, when the first crack happened in the regional banks. The VIX went skyrocketing up to the 30 level. But here we are again in the teens. Just like that, volatility is right back to the bottom of that trade range. What levels are you watching?
Yeah, again, I've been watching the VIX, and I mentioned in the past few months that the key areas are 20 and 25 or so, right? So we broke below 20 short term. We're at 19.34 spot, which it's about 1.25% moves in the broad market on a daily basis. Seeing suppression in the VIX leads me to believe that, again, the bears don't really have much ammo in the short term, and we're going to see more upside, as I said, on SPX and the Qs. But again, if we get some kind of news event that comes out of nowhere, another bank failure, for example, that could cause a huge spike back to 25 and possibly even higher to 35 or so, which would cause a decline in the broad markets as well. Now on page 8 here, we have the US dollar index. What's your thinking here?
Well, Nick, we had a breakdown on last week's FOMC, and really the dollar has just continued to remain very weak. Now, at this stage, it's on the table for a full retest of its previous lows as the euro and even the pound sterling continue to edge higher. What continues to be interesting is the Japanese yen continues to seem to almost decouple from this and is not staying in that bigger correlation. But right now, so long as those European currencies continue to show this kind of short-term strength, the dollar index going for a double bottom retest at 101 really does feel like the path of least resistance.
Now on page 9 here, we have gold futures. What are you guys thinking here?
We're struggling to overcome round number resistance at 2,000, and we just had the futures contract roll. There's a lot of contango in that contract, so that's going to help it by a few dollars to get closer to that 2,000 number. I'm still bullish, but there's plenty of room in this trading channel for a deeper correction before the bull trend resumes. The key will be closing and then staying over 2,000, the round number resistance, for a few days. When that happens, that's when you could expect to see a big upside move start to take off. The next big technical levels to test after 2,000 would be the March 2020 high at 2080, and then the 2020 all-time high at 2092. The upper trend line on the price channel, though, doesn't really get up to that 2080 level until around April 19th or so. And, to get up to 2092 would be a couple days after that. So I wouldn't be surprised if we consolidate here for a couple of weeks before we see the next leg higher. But I do still expect eventually that we're moving higher. And I think that if we are able to break to new all-time highs, could be the beginning of a really big move up, especially if this banking crisis resurfaces and or if the Fed is forced to cut interest rates. But let's not forget that the 2020 high was on the back of the biggest stimulus in history at the height of pandemic fears. And the 2022 high was on the invasion of Ukraine with talk of nuclear escalation in the air. That means that these levels should offer plenty of resistance before the market eventually works its way through them. So I won't be surprised if, by the 1st of May, if we get up and test those levels, but I'm not expecting to break out to new all-time highs overnight. I think it's probably going to take a while to get through some really tough resistance up there around 2080 to 2092.
Yeah, Eric, I agree with your consolidation idea, but so far the consolidation has been more sideways than it has been downwards. The fib zones lie toward 1900, and I would still view that as a tactical place to be looking for buy on dips, but the question is, will gold even give that? Overall, we have to respect that the prevailing uptrend is the dominant one, and what doesn't even show on this chart is that we are just a stone's throw away from decade highs, if not all-time highs. And really all we need is one real good bullish catalyst, and that round number 2,000 resistance up above can get beaten and create a feedback loop that will drive potentially solid gold flows for even weeks or months to come. The big question, will it? And that's certainly the thing to watch. Right now, definitely the bulls have trend in their favor. We are consolidating here, but so long as old dips continue to be bought and the trend remains intact, more upside in gold remains my bigger bias.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.